So you just got bankrupt by 14% even without you realizing it. Hi everyone, welcome to today's video. So let me start today's video by asking you a very interesting question about silver and gold. You might have read in the history books that several kingdoms and countries in the past, they used to use both silver and gold as their currency or coins. But as the years transpired, fewer and fewer silver currency used to be used. But gold did not lose its value. Even till today, silver has lost a lot of its value in real terms compared to gold. Why is that the case? Both are rare metals, both are very difficult to extract. But why is it that gold has stayed prominent in its value, but silver has lost insane amount of its value over the years? More importantly, how does that entire scenario is playing out when it comes to fiat currency? Because you would have seen charts like that India is losing 4% of its value compared to US dollar. US dollar itself has lost like 97% of its value over the last 100 years. So this type of data is strongly related to the story of silver and gold. Now, I would really want you to pause this video and type out your answer in the comment box as to why do you think that gold has stayed prominent but silver has not to that extent. I would love to know your answer. So here is the very quick explanation. While there are several factors at play for this phenomena, there is a very important point regarding this explanation. So let me do a very quick comparison and then I will relate this to today's stock market and how you as an investor are likely to lose a lot of money if you do not understand the concepts that I'm teaching you on this particular video. So just to help you quantitatively understand the decline in the prices of silver, take a look at this chart. This is the last approximately 100-year chart and it shows that back in 1915, silver used to be priced at $14.6. In real terms today, if you adjust for inflation and bunch of other different things, the price of that same silver dollar is roughly $24.83. What it simply shows is that over the last 100 years, silver has not even doubled in its value. So let us take a very quick look at the gold chart also. So for example, if you consider 1915, gold was at roughly $556. In real terms today, gold has almost 4x in price. So silver did not even go 2x, but gold in real terms has become 4x. So what is the primary reason for this? Now this particular price growth difference between gold and silver can be easily understood through something called as the mining ratio. So take a look at this particular chart. It says that the mining ratio of gold versus silver is 8:1. So which means there can be 8x supply of silver that can be added compared to gold. So for example, if there are 8 kgs of silver that can be added into the economy every single year, then only 1 kg of gold can be added into the economy every single year, which in other words means that it is much harder to mine something like gold or create gold vis-a-vis silver. This brings us to a very simple concept of something called as hard currencies. So hard currencies are very difficult to produce. For example, gold is very difficult to produce compared to silver. If you go to copper, it is much easier to produce compared to silver. If you go to money, for example, US dollar or INR, they are probably the easiest to produce. I'm not trying to criticize anyone. Just think about it logically. Is it easier to produce gold or is it easier to produce money? So this is the precise discussion that we are going to have on today's video, that why do I feel that fiat money is the easiest to produce and how that is kind of bankrupting us. And even if you keep 100 crore rupee in your bank account magically, even then you're not really safe. Since we are on the topic of safety, this brings us to the sponsors of today's video, which is Ditto Insurance. You can buy health and term insurance from Ditto. I have personally purchased my insurance from Ditto, and the best part is that you get to speak with an insurance expert absolutely for free. So you can check the links in the description box and avail that free service. So let us get the discussion started, and there are 3 specific parts in which I will help you understand this topic more. One is that I will help you understand the history of fiat money, that how is it that the fiat money has evolved over time? Was it always the case that it was getting devalued at a crazy rate? Second key thing is that how this excess printing of money impacts your stock market investments, impacts your savings rate, impacts your entire wealth, so to say. And third and finally, what is it that you could consider doing considering the macroeconomic scenario? This is going to be a fascinating story. Also, a humble request, if you like these type of videos, do press the like button. It will indicate to me that you would want me to make such topics. So let us start by understanding a very brief, summarized version of the history of fiat money. So the history of fiat money can be understood in 3 simple parts. So the first part is regarding the British Empire, because it became one of the modern countries in the world that kind of set the gold standard, and it was the first country that moved away from the gold standard and kick-started the fiat economy. The second phase or the catalyst was World War I, and this is a very important war. You need to really know about World War I from a finance point of view because the repercussions of World War I on financial markets exist even till now. I'm going to prove it to you. Third and finally, that what is the impact of fiat in the contemporary world and how do I see things evolve? So we will understand this story in these three phases. So United Kingdom or the British Empire became the first major economy in the world so as to adopt the gold standard in 1777. By 1821, it became the first country to officially adopt a currency backed by gold. So what does backed by gold in simple term means? So before having a currency backed by gold, what used to happen was that if you wanted to trade with anyone, you had to give your gold coin in exchange for other gold coin. For example, if I simply wanted to buy a horse, then the only way for me to trade in that horse was that if I gave that horse trader one of my gold coins and that person gave me his horse. With currency backed by gold, what used to happen was that there was a government or a bank in the middle and you could give your gold coin to the government and they will issue this receipt called as the gold deposit or gold receipt, and there used to exist a one-on-one pegging ratio. So it simply meant that every time the government issued this particular receipt, they used to keep an equivalent amount of gold in their tijori or locker. So that was a simple point about one-on-one pegging with gold. Now this can be further understood from this particular graphic. Now you can clearly see that gold certificates were used as paper currency in the United States also from 1882 to 1933. These certificates were freely convertible into gold coins. What it meant de facto was if I owned a gold certificate and if I went to the government bank or government and told them that, you know what, give me my one gold coin back, I'm holding this certificate, then they would have had to do that. So that was a simple basic point regarding gold backed currencies. Then comes the natural question that was the system working well? The short answer is yes. Then comes the another natural question. Then what happened that the world had to move away from this gold backed currency system and create so much of artificial wealth that we see existing today. So the answer comes up in 1914. That is when UK jumped into World War I. So World War I was one of the major events that reshaped our history from all spheres, especially finance. And in 1914, one major event that happened was that the British Empire declared that, hey, that we are going to jump into World War I. Now wars are extremely costly. And how do you finance war? You finance war in simple terms by gold, because till 1914 gold was the major currency that existed. You might have seen Game of Thrones. I'm a big fan of that show, and every time there were mercenaries that were hired, in what currency they used to get paid? Gold. Every war that was fought before 1914, how the mercenaries or armies were paid? They were paid either in gold or silver or in some rare commodity, so to say. So this system changed in 1914, and the financial instrument that led to this change was something called as war bonds. So how do war bonds typically work? So they work in the following manner. So in simple terms, war bonds work in this way. For example, the government will issue a bond to the UK citizens, and they will be asked that, hey, you know what, we are fighting a very bloody war. Would you like to finance this war? It will display to us that you are patriotic, etc., etc. So the UK citizens will say that, okay, no problem. I'll give you all these gold coins. You take these gold coins, and whenever the war gets over, please pay me a certain rate of interest on it, and we are good to go. Till then, I will hold these bonds. Bonds are nothing but a receipt that you, as a citizen, have given the government your gold, and in return, you will get a certain rate of interest plus some principal amount payment at a certain future date. So back to 1914, the British government jumped into this bond financing, and they were able to raise only 33% of the money that they could have raised. Now that's a problem. If they needed 100 gold coins to fight a war, they were only able to get 33 gold coins. It's a huge deficit and it's a huge problem. So that is where the first steps of quantitative easing, as we know today, started being exhibited. So in England, back in 1900s, there was a central bank called as the Bank of England. It had a lot of gold in its tijori. How did it get all that gold? Again, go back to the previous section. They procured that gold by issuing gold-backed currencies to people. People gave away their gold to the central bank. So Bank of England ended up purchasing 66% of this bond. Now here is the crazy part. If you think about it from a philosophy point of view, this was the first instance that the gold standard was somewhat destabilized. And this was the first instance that the government ended up using the gold that it did not own for its own gains. And it was great for the government. They were able to finance the entire war, but the economic repercussions of the war, someone has to bear it. But by mid-1920s, the inflation was very high. Why high inflation? Because government ended up spending money that it technically did not own. And that led to high inflation. And every time there was high inflation, a justification was there that, hey, it's because of war. Therefore, we have high inflation. True, it was because of a war, but you fought that war on a debt. So that led to a very high inflation and a full-blown depression by 1930s. But hey, majority of the governments in the world are arrogant. I'm saying it in the nicest possible manner, that governments are actually very arrogant. They, rather than admitting their fault, they adopted something called as Keynesian economics in practice. Now, I'm not speaking against Keynesian economics. If you want, I'll make a separate video on that. But the roadmap from 1930s became really simple. That hey, if we can get away by printing money and using money that we don't own, then we can do it forever. So many countries after 1930, 1940, they started abandoning the gold standard. Why? Because they could print free money and use it for their own political gains. And that system has become full-blown as of now. In fact, if you check the data, in 2020, approximately 80% of the currency in circulation in the US has been printed post 2020. What is the simple roadmap that governments across the world are following now? It's very simple. It has existed since 1914. That every time there is a problem, print and print and print more money. When the inflation goes high, blame it on pandemic, blame it on World War I, blame it on the Great Depression. But many of these things, one could argue, I'm not saying this is 100% correct. There are pros and cons to it, and it requires more elaborate economic explanation. So I'll not give a verdict there. But many of these problems, one could argue, have been created due to excess printing of soft money. So before explaining how this entire dance is bankrupting you and I, let me share 4 key concepts with you, which will help you wrap around your brain as to what the truth behind the modern day financial system is. So 4 key points. So first and foremost, you need to understand that what are hard assets versus soft assets. Now, soft money is very easy to produce. One could argue that the fiat money, be it Singapore dollars, INR, US dollar, they are the easiest thing to produce on earth. Any other asset, compare it to property, compare it to gold, compare it to silver, compare it to platinum, copper, whatever. All these things, very difficult to produce, but fiat money is probably the easiest thing in the world to produce. And now the situation is such that the interest rates are close to zero, that governments can borrow from us at 0% rate. So that is what the situation currently is. Hard assets on the other side, for example, if you consider gold, silver, copper, anything else, it is much, much harder to produce. Therefore, it has somewhat of a tangible value, so to say. Again, go back to the example of gold versus silver. Gold, really difficult to produce, has a lot more value compared to silver. Silver, lot more value compared to fiat money. So this is the first key concept. Second key concept that you need to remember is that soft money or any type of fiat money can have literally infinite supply. Now, what does that mean? That tomorrow, if the government decides that the total supply of money in our economy is $1 trillion, hypothetically speaking, they can easily make it to $10 trillion. And if you have 10 crore rupees saved, guess how much it will fall by. You would say that, you know what, Akshat, you're just blowing things out of proportion. Such things do not happen. Okay, I can give you 10 examples of nations where such things have exactly played out. Check Lebanon, check Sri Lanka, check Zimbabwe, check Mexico, check Venezuela. You will see this play out over and over and over and over again. Now comes the third and the most important point, that if you think about it logically, that okay, no such extreme situation is going to happen in India or the US. You are right, maybe not, maybe it will take a lot of time, if ever, but money supply is definitely going up because countries are creating more and more and more money. Why? Because it is free. And every time they turn on the printer, the value of the money that you hold, it kind of goes down. So if you are invested in soft asset, there is just no way that you will be able to save money. Now, unfortunately, we have reached a stage that majority of the population on earth do not have access to financing. Even people who are good at mathematics, engineering, bunch of other different things, they have trouble beating inflation, and the systems are designed in such a way that people on Wall Street, they have supercomputers, bunch of other different teams, and best of the research available, majority of them are not even able to beat inflation. So what does that mean? It simply means that the value of your money is going down every passing day. I'm not trying to scare you. I'm doing a thoughtful exercise with all of you. If you feel otherwise, feel free to comment. I'll be more than happy to respond to you. Fourth and final point, that all this can be tied to something called as inflationary politics. Go back to 1914 again. Why did the UK need to fight World War I? There is no specific consensus, and theory suggests that there was literally no need of fighting such a war, but it became a political convenience. Once you fought the war, you can rally people around it, stir up patriotic, nationalistic sentiments, and get people to do and agree to literally anything that you feel like. So over the years, our politics all across the globe has become inflationary politics, which leads to one simple solution from the government, that print as much money as you can can and bankrupt normal people. Now you would say, Akshat, you are being extremely harsh. People are not getting bankrupted. Okay, I'll give you an example. For example, let's go back to 2020. If you were planning for retirement, if you would have saved 2 crore rupee, the FD rates were cut from 6.5-7% to let's say 5%. Now that 1% change on your income, just compute and tell me, I had done a separate video on that 1% change on FD rate impacts your per year spent by 14%. So you just got bankrupt by 14% even without you realizing it. So that is the simple system that is playing out. So now comes the last section, that what is the impact on you and how you can save yourself from this situation. So let me speak about it one by one. So the impact on you is manifold, but I'll speak about three prominent things. One, we spoke about retirement just now, that if you are trying to save for retirement, you must try to invest in cash flow oriented products. For example, commercial properties. I'm a big advocate that you should consider investing in commercial properties because commercial properties generate a cash flow. If the soft assets blows up, something like a commercial real estate would be a very good hard asset to own. Second key point, that please invest in stock markets. Why? Because think about it this way, that you might have seen that after 2020 COVID, a lot of companies gave massive return. The world was stagnant, world was not moving, but stocks like Google, Amazon, bunch of other different Indian companies started cutting their previous peak also. Why did that happen? It happened because of excess money printing. People keep on debating that, Akshat, you know what, PE ratio of this company is very high. You made a Nestle video, PE was very high. Why should we consider purchasing such stocks? First and foremost, not an investment advice. Please do your own due diligence and analysis, but think about it this way, that if the total supply of money in the economy was $100 trillion, then it ended up moving to let's say $300 trillion in step 2 after 2020. Where is this $200 trillion of excess money will go? It will go to companies. Of course, PE expansion is going to happen because the price of everything will go up except for the soft money that is there. So please do not worry about PE and please learn a little bit about macroeconomics. Learning about macroeconomics will be the only way of making money. Again, think about it this way, that a company's stock price these days is less dependent on its internal growth and revenues or profits, but more dependent on how much money is being printed, how the bond market is behaving, how many Fed interest rate changes are going to happen, whether the interest rate is going to go up or down, how is the supply chain or commodity prices going to change. It is funny to keep on seeing people use 500 different type of indicators and none of those indicators would work if the Feds decide to turn on the printers. Third and finally, please understand the difference between hard and soft asset. In case you want me to make a part 2 of this video, I'll be very happy to do it. If the video hits 20,000 likes, I'll make a part 2 and explain this difference of hard and soft money in more detail. And we'll talk about specific positions that you can take to hedge against government actions. That's a simple viewpoint. To hedge against government actions, because one could argue that fiat is the most useless asset from an investment point of view. So in summary, there are a couple of things that I will leave you with. First and foremost, please learn more about hard assets versus soft asset. Number 2, please learn more about macro investing. It is going to become one of the most powerful forms of investing going forward. Again, if you want me to make a part 2 of this video and explain what macro investing is, and also get this video to 20,000 likes, and also check the links in the description box. I will put some interesting reading material there. Thank you so much, and I will see you the next time.